Hello, everyone. I'm John Fiella, founder and editorial director of Smart Energy Decisions. Welcome to the May 28th edition of the Smart Energy Decisions webinar series, which is devoted to delivering insights and useful information for large power users on best practices in energy management and renewable energy sourcing. We've got a fantastic turnout for today's webinar, which I think is testimony to the timeliness of the topic and the high level of interest in the most dynamic energy market in the United States, ERCOT. First, for some housekeeping, please enable pop-ups within your browser and turn on your system's sound to hear the streaming presentation. If you'd like to ask a question of our presenters, please submit them at any time during the webinar on your console. If you need any technical assistance, just click the help link or submit a question and we'll respond right away. We're extremely grateful for the growing readership and engagement of our community at Smart Energy Decisions. Our mission is straightforward. We're here to help large power users like you improve their profits and reduce their carbon emissions by adopting best practices in energy efficiency and renewable energy sourcing. This webinar series is just one of the many programs and services we produce in fulfillment of that mission. Here's a look at our lineup of face-to-face and virtual events during the rest of 2020. In case you missed it, we announced that our July Renewable Energy Sourcing Forum will take place online as a virtual event. We're excited about bringing a new event experience to the community. All of our events in 2020 are guaranteed to take place either physically when possible or virtually when necessary. You can visit our website, smartenergydecisions.com, for more details. That's enough housekeeping. Let's go ahead and jump into today's topic: navigating energy planning in a COVID-19 economy, ERCOT. The impact of COVID-19 on ERCOT has made an already dynamic energy market even more challenging to manage. In light of these impacts, the key issue for you to really be thinking about is, how are you going to manage your energy strategy in ERCOT today? To answer that question, we have three experts from NRG who will address three critical topics at the root of this issue. First, how should you be putting current economic and energy news in perspective? What does all this mean to energy pricing and supply choices? And then finally, what steps should you be taking now in your energy planning? We're fortunate to have three knowledgeable subject matter experts from NRG with us today to address these important topics. Our first presenter will be Bill Barnes, Director of Regulatory Affairs. Bill has over 20 years experience in the U.S. power industry and is currently responsible for covering ERCOT market design issues for both the retail and wholesale markets, in addition to providing market analysis, commercial advice, and regulatory advocacy. He also represents NRG at ERCOT and the Public Utility Commission of Texas. Following Bill will be Stephen Batchelder, Managing Director of Origination. Stephen has been active in the energy commodity space with a primary focus in the ERCOT electricity markets for nearly 20 years. Stephen's base knowledge of the electricity and natural gas markets developed early in his career while working in various trade control and risk control positions. Finally, the presentation will be wrapped up by Bradford Pete Hill. Bradford has worked in the energy efficiency, energy infrastructure, and renewable energy sectors for over 12 years. He's currently responsible for the development and execution of renewable retail electricity supply solutions for Fortune 100 clients and other large power users. Bradford also advises corporate executives and public officials on innovative funding strategies, public-private partnerships, and project delivery methods. All right, well, that covers all the formalities. Let's dive into this meaty collection of topics. I'd like to turn it over to Bill Barnes, who'll get us started. Bill, take it away.
Thank you, John. Appreciate the introduction there. And first of all, just wanted to say, hope everyone is staying safe out there and keeping your sanity. This is clearly the events of this year so far have been truly remarkable and unprecedented in terms of its impact to not only the economy, but also to the industry that we participate in Texas, in the U.S., and around the globe. Texas, in particular, has really experienced an unprecedented 1-2 gut punch in terms of impact to its economy. And the first major impact really began before the full effects of the pandemic had really set in, and that was a historic drop in oil prices and oil and gas drilling activity, which was triggered by the oil price war between Saudi and Russia. Really came to a head at the beginning of March, and we were starting to see some of the oversupply situations cause impacts at the end of February as well, which then followed into the impacts of the pandemic and loss of demand due to stay-at-home orders, which really contributed to a significant drop in oil demand and oversupply, which led to crude prices tanking and going negative for the first time in its history. That was obviously caused, a large drop in drilling activity, as we all would expect. And that drilling activity, particularly in West Texas and the Permian Basin, has a huge impact on not only the state economy, but also the fundamentals of the electricity market, which we're going to take a look at. So following those impacts from the oil market, then were trailed by a substantial, unprecedented, historic impact to the economy as a result of the pandemic, caused by the stay-at-home mandates that were necessary to slow the spread of COVID-19. And the charts on this slide, I understand, are probably going to be difficult for you to make out, so I'm just going to talk through some of the highlights just to show the magnitude of the impact to the Texas economy. And this data is from the Texas Workforce Commission. First is the now infamous chart on the left, which there's one for total U.S. unemployment claims filed as well. This one is specific to Texas, which shows a historic 1.94 million unemployment claims filed between March 21st and the beginning of May. And that is unmatched by any of the historic events prior to that that caused increases in unemployment, including Hurricane Harvey, the Great Recession, Hurricane Rita, and the 9/11 attacks. By substantial magnitude, again, millions of unemployment claims filed in a matter of 2 months. The chart on the right shows the unemployment claims taken cumulative for 2020, and what it's showing is we have pretty much met we met the total unemployment claims filed for 2019 at the beginning of April. And at this point in May, we have pretty much tripled that. So on a rolling basis, there have been 41 months worth of unemployment claims taken in 56 days as of the beginning of March, which is truly unbelievable in terms of its impact to the Texas economy. As a result of those events, the Public Utility Commission of Texas really stepped up and reacted in a very prompt way and implemented just an equally unprecedented regulatory action in terms of establishing a customer relief program. And that has been deemed the COVID Electricity Relief Program, which established a fund that is assessed the customer's bill through a rider, and that fund is then used to partially cover bad debt for serving those customers impacted by COVID-19 that have met eligibility requirements. And in turn, those customers are protected from electricity disconnects. Again, truly an unprecedented program and response by the PUCT and stakeholders in order to manage through this event. And so what makes this event, I'd say, pretty interesting and remarkable in terms of its impact to the electricity market is how well the ERCOT loads have held up, given the substantial increase in unemployment and impact to small and not only small businesses, but also commercial and industrial consumers as well. So ERCOT has published weekly analysis where they are comparing the actual loads experienced for that particular week compared to a baseline using a model tuned for pre-COVID economic conditions. And so really this analysis is showing what the ERCOT load was expected to be prior to COVID compared to what it actually was. And that analysis showed that we really did not start to see impacts to electricity consumption until really the end of March. Electricity demand and consumption held up for the most part through the entire month of March, and it wasn't until the last week of March that we started to see an impact, which was where we start to see electricity usage decline by about 2%. Obviously with stay-at-home orders being in full effect for the month of April, that's where we saw the biggest impacts. Electricity consumption and demand hit their trough, the lowest point, in mid-April, where with demand down around 4 to 5% at its lowest point. With the stay-at-home orders being lifted in beginning of May, that electricity consumption has started to recover, and as of mid-May, we've seen that usage now down only 3 to 4% compared to the peak demand on a daily basis down about 2 to 3%, which is pretty remarkable given impacts to electricity demand in other markets, such as PJM, New York, and ISO New England and California, which all saw reductions between 7 to 9%. So given the impact not only to COVID, but also West Texas and the oil crash, that is a pretty remarkable observation that that load has remained so resilient. So not only has it remained resilient, but according to forecasts, it is expected to remain resilient as well, which is, again, a testament to the Texas economy and the strength in the businesses that are here. With ERCOT estimating an average 2% reduction in peak load, again, from their pre-COVID load forecast to a post-COVID forecast for 2020 through 2024. That forecast was published in their Capacity, Demand, and Reserves report. They provided a COVID impact scenario versus a status quo, again, using models developed on economic assumptions prior to COVID. So what's, again, remarkable about those expectations is that the load in ERCOT is still expected to set a record for this summer and continuing to grow at about a clip of 1.8% over that 2000 to 2024 period, which in the table on your screen, you have the results by weather zone and the total ERCOT peak demand for pre-COVID assumptions on the left compared to on the right, post-COVID adjustments made to that peak load. And what you'll notice in the chart, again, which is by weather zone, the far west weather zone, which includes the Permian Basin, has by far the largest impact and reduction, which is about 19% due to the pullback in oil and gas activity. So while the state certainly is going to feel the effects of COVID-19 and stay-at-home orders, West Texas and the impact of the oil price decline and oil and reduction in oil and gas exploration activity is by far the driver when it comes to impacts to electricity demand in Texas. ERCOT also updated their reserve margin forecasts, which obviously with lower peak demand and lower load will increase those reserve margins. They made adjustments to the load forecast. However, they did not make any adjustments to the supply side. So no change in new build assumptions. All projects that were in the interconnection queue are assumed to continue on the path that they have indicated, and there were no adjustments to a reduction in supply as a result of supply chain issues or any other impacts that may slow down or result in canceled development projects. So again, that shows you while Texas has been impacted and will continue to be impacted by the effects of the oil price decline and COVID-19, compared to really the expectations, it's held up pretty well and is expected to hold up pretty well. And so with that, I will turn it over to Stephen.
Thank you very much, Bill. And John, Bill, and Bradford, we'll reiterate again, it's always fun to do these things with you. And John, appreciate you hosting us today. And Bill and Bradford, always an honor to be involved in these conversations with you guys. So to that end, I think what we'll do is just take a quick look here at some of the themes that Bill has laid out and some of the kind of more macro impacts on the ERCOT market. What we're going to look at is kind of what influence we've seen those effects on the energy market and energy pricing. And so looking at some short-term and some longer-term impacts, one of the first things we wanted to look at was the next 3 or 4 summer prices. And we've always defined kind of summer pricing in ERCOT as the months of July and August with the on-peak Monday through Friday 16-hour strip. So just looking at summer on-peak prices, one of the phenomenons we've seen is as the load picture in ERCOT became very uncertain with the impacts of COVID-19 and stay-at-home orders and businesses shutting down, et cetera, we decided to take kind of a 6-month, historical look at where prices have been trending. And as you can see on the slide here, the biggest impact was in the summer, July-August 2020 range, where prices were steady somewhere between $140 and $150, kind of on a market expectation of where they thought prices would clear this summer. And then as stay-at-home orders got put in place and we started to get a little bit better picture of what the load forecast may look like for this summer in ERCOT, we saw prices come off quite a bit, pushing all the way down closer back to the $100 level. And so the first impact that we kind of noticed on this chart was that if you looked at the spread between each of the next 4 summers, summer 2020, 21, 22, and 23, the range of outcomes on those summers was nearly $80, where you had summer 20 trading at, as high as $145 per megawatt, and you have summer 2023 trading down around the $65 level to create that $80 spread amongst the summers. When summer 20 came off with the uncertain load picture in ERCOT, that spread amongst the summers collapsed, all the way down as low as $35 in that range. So there was a compression of the range of outcomes expected from the market in the next handful of summers and the pricing components behind them. We have since the last, starting on Thursday or Friday last week and into this week, we've seen a little bit of a rally in the summer 20 pricing. It's kind of ticked back up to the $110, $115 level the last few days. I think based largely on part of Texas reopening and having a better idea of what the load forecast may look like for this summer. So that's just a little bit of a look at kind of what's driving summer pricing, where obviously, the generation is at its tightest and demand is at its highest in the market, are the summer periods in ERCOT. Now, when we take that and juxtapose it with looking at the 10-year strip on the right half of the slide, the 10-year strip continues to remain very resilient. So we took a 10-year strip of looking at pricing between calendar year 2021 and 2030, and those prices have continued to only range about $2.50. So looking at on-peak summer prices where they can range $80, looking at the 10-year strip, you see that it doesn't move and doesn't nearly react at the same pace that the summertime prices might. So, looking at the 10-year strip, we also went back about 6 months on that into November of last year, and that the high point on the 10-year strip has been around 25.50, and that was in April of this year. The low point has been, down around December of 2019, and that, like I said, that range of outcomes is really only about $2.50. So if you're thinking about your energy spend and you're thinking about budget outcomes as they continue to be at the forefront of your mind for energy consumption, if you're still willing to take a long-term view, there's still great value to be had out on the curve, looking at that range of outcomes on an around-the-clock basis from, mid-low 20s to kind of mid-20s. So that's just a quick look at kind of two of the pricing components that we think about in our day-to-day business and how we think about customer transactions and what might impact customer decisions. So on the next slide, we just talk, real briefly. I know this is, this is something that's at the forefront of everyone's mind in ERCOT is the high price cap in the energy-only market outcome where you can see prices accelerate as high as $9,000. We saw that, phenomenon last summer as well. So how high can prices go? Well, there is the $9,000 price cap in place in ERCOT. And, we look at that in contrast to exactly what I was talking about on the last slide, where you see, 10-year prices still out from an around-the-clock basis out, in the mid-20s. So there's obviously an extraordinary range of outcomes that are possible here in the market. ERCOT continues to have a legacy thermal fleet. A couple of years ago, we saw some coal retirements happen in ERCOT. It was a dramatic change for the supply picture in the market. But we also continue to see renewable build out occurring at a fairly rapid pace in ERCOT as well. So it is a dynamic and changing supply side picture in ERCOT, and one that presents challenges on both sides of that. The other thing we keep a close eye on is the ORDC, the Operating Reserve Demand Curve, which is an administrative price tool that ERCOT has put in place to help incent generation to be built and maintained in the state. In going into summer 2019, the PUC approved a half standard deviation shift in how that curve is calculated and how the price adder is calculated. It was administered as a quarter standard deviation shift for 2019 and an incremental quarter standard deviation shift going into 2020. So, the ORDC adders that were present last year will be different again, even for this summer, due to that extra quarter standard deviation shift. So, there is a little bit of thought that needs to go into how people are reacting to ORDC adders and how those influence prices in ERCOT as well. So just a quick look there on kind of the pricing structure in the range of outcomes. There's, thematically speaking, there's quite the range, and I don't think, short of maybe Australia, there's not another market like this anywhere in the world that can create this wide of a range of outcomes. So moving on and thinking about how this can have an impact on your supply choice as you're an energy manager and a decision maker on the load side of the market. Obviously, there's things that are in play now with the COVID-19 and stay-at-home orders that have not been there historically. One of the things we talked about briefly a minute ago was the changing supply side picture in ERCOT and how the fast and rapid pace of renewable build out has occurred in the state, and how that there might be some underlying impacts from COVID-19 on that build out. It's one of the questions we get quite a bit. So I think there's kind of some micro level thoughts and some more macro level thoughts around impact on renewable build out in Texas. I think the first one is that, with stay-at-home orders and people not being able to get out as much and move around as much, I think it did have a very short-term impact on labor and, people's physical ability to get out to job sites to work on projects. I think that probably is more of a short-term kind of micro-level impact. I think some of the more macro-level impacts are around what this means for the job market, the labor market, and certainly have to factor in thoughts around supply chain disruptions globally as well. So I think you can have impacts on, more local job-based, labor force-based impacts on projects, but you also have to keep an eye on what macro, more global issues may be out there with regards to supply chain and availability of parts and components. But as states continue to open up and as global economies continue to open back up, our view is that these are going to be more short-term in nature, especially when you think about the life cycle of a renewable asset or any generating asset for that matter. That they're not decisions based on a 1 or 2 year time frame. These are 10, 20, 30-year decisions that are being made on these assets. So we certainly think that there's going to be a resurgence here of projects coming back into the market. So kind of thinking about wrapping up this portion of the conversation, one of the other questions we get quite a bit are, if we have any views on how and when the economy is going to start to rebound and when things are going to start to open back up. Obviously, there's some regional things at play here where some of your southern states with, not the same population density as other parts of the country, particularly in the Northeast corridor, are going to have to open at different paces and different strategies. So, focusing on ERCOT on this conversation, I think, Texas is very clearly getting back open for business. We're seeing the same thing that we're starting to do. The state is opening up quite a bit, and things are, I'm not anywhere ready to say getting back to normal, but you're starting to see people out and about more and more with restaurants and other venues where people would congregate, starting to get back into recovery. So I think it does bring back classic, 4 stages of economic recovery, be it a V-shaped recovery that's a quick bounce and we're right back to business. The potential for a W-shaped recovery where you have a quick recovery and then some sort of secondary pullback. There's a lot of headlines and articles being written about, a second wave of the pandemic and a second wave of COVID-19, and that certainly is a risk that everyone needs to keep an eye on and an unknown as we kind of move through time. A U-shaped recovery would be a lower shaped recovery, a lower recovery, but just takes more time, has a longer runway before things get back to normal. And then an L-shaped recovery where you might see some, especially in the small business market, where you might see some businesses that never come back just because this pandemic and the way that we've reacted has permanently shifted those businesses. So I think there's different outcomes for different regions. I think there's certainly different outcomes possible for different parts of the globe, and it'll be fascinating to see how things play out over time. But certainly in ERCOT and certainly in Texas, it feels like things are starting to regain steam a little bit, which is also you're starting to see that when people that have a position on that has an impact for summer 2020, those that have a belief have indicated with this little rally in summer 20 that it certainly feels like pricing is indicating that Texas is starting to get open back up. So anyway, that's a view from my seat on kind of some of the larger themes that we're looking at and some of the things that we talk about amongst our team every single day. So to that end, I'm going to transition over to Bradford, who can take it from here and talk about more specific impacts to your day-to-day business. So Bradford, take it away.
Thank you, Stephen, and thank you, Bill. That was a lot of great information at one time, so that was great. And thank you to John as well for hosting this webinar today. I always, as Stephen said, I always enjoy these. Good afternoon to everyone on the call, and I appreciate you joining us as well. As Bill and Stephen established, the road ahead is complex. It's dynamic and it's ever-changing with market volatility and economic swings. You know, with all that information, what are our next steps, right? What is our path forward? As a business leader, you will be asked to navigate a series of factors that are impacting the ERCOT market and your operations on a daily basis. As it was stated, these include market volatility, the to and fro of supply and demand, increased use and reliance on intermittent renewable energy, and an economic recovery stemming from the COVID-19 global pandemic. Now, we're told the goal is to guide our business safely to what is being called the new normal. And the expectation is to guide our business in as good as or better condition than it was pre-COVID. So they want us to improve on what we're doing. And right now, this can seem like a daunting task with everything that's going on. In order to maneuver through these unprecedented times, you want to leverage all of your available resources to maintain a constant flow of pertinent information, innovative ideas, and operational continuity. There's a lot of information out there right now, and sometimes it's very difficult to sift through to find those golden pieces. One resource that I would feel will be essential over the next year and beyond is a solid energy partner who understands your business, your operations, and the customers and communities you serve. So we at NRG, we aim to be that critical customer-focused resource and your long-term strategic partner. Like you, COVID-19 has impacted our customers and communities as well. So we understand. We're experiencing it too. As the battle to contain COVID and the economic pandemic continues, we too wanted to step in and help, just like many of you have, and many of your corporations have. So NRG has committed $2 million in charitable contributions to aid those on the front lines of the pandemic response and provide relief to those who've been adversely impacted by the stay-at-home orders. So these contributions include cash funding and in-kind contributions to first responders for safety supplies like PPE. We've also purchased and distributed protective apparel and air purifying respirators. We've also made donations to community and small business relief funds in locations where we operate. And lastly, we've made financial contributions to teachers across Texas and other regions through DonorsChoose.org. Our hearts and thoughts go out to people who have been impacted by this worldwide crisis and are doing their part to keep our families and our communities safe. We continue to appreciate all of you who are on the front lines and working to contain COVID-19 and its impact. As I stated earlier, NRG is a community and customer-focused organization that empowers consumers with personalized energy choices and solutions. And we're committed to making power a reliable and constant presence during the COVID-19 crisis, and we have options for customers who are experiencing challenges. So if you're dealing with urgent concerns about billing or other aspects of your energy plan, we're here to help. Energy customers experiencing difficulty should call their account executive, broker, or they can email us at solutions@nrg.com. We've also published a COVID-19 FAQ at nrg.com that I would suggest everyone read as a great resource. Now, looking to the future, to the path forward, I have customers who say to me, Bradford, I understand and appreciate NRG's commitment. But when we're talking about energy matters, how can NRG help me? I think it goes back to what I said earlier. It's all about pertinent information, innovative ideas, and maintaining continuity. So NRG has many experts like Stephen and Bill. I've worked with them for the past couple of years, and they've been through hurricanes, tropical storms, recessions, scarcity pricing, and I've learned so much from them. And they, like many of our experts, are at your disposal. And they're well-versed in serving the needs of Texas businesses in a range of scenarios. Along with our experts, you have access to an NRG account representative that will be your personal business partner. Each of our representatives is a highly trained veteran of the energy industry and specializes in developing customized solutions tailored to the unique needs of your business. Working with your account representative and supporting them will be a team of energy specialists, and their job is to adapt your energy plan to your changing energy needs while mitigating exposure to volatility, market risk, and scarcity. Now, for day-to-day operations, we have a highly trained account management team that will oversee all aspects of your billing, your operational needs, and to customize the back office solution that works for you and your team. In parallel with this account management team is our world-class account management portal or account management tool. This provides a powerful energy management resource at your fingertips. You can log on at any time, and you can pay your bills, reconcile invoices, access market data, and manage your electricity usage and costs almost instantaneously. So, nevertheless, with all of these different features and benefits, the main question is, how do you know if it's time to reconsider your energy plan, especially during the ERCOT market changing, as Stephen and Bill described, and a true just overall global economic shift? So what I've done here is I've put together 5 points that I want you to consider. If you have questions about these points or answer yes to any of these questions, we want to speak with you. So number 1, has your financial risk tolerance changed? Do you need to engage in a more consistent or predictable budgeting cycle? So say you're on a market-driven energy plan and are unable to manage and mitigate the risk that comes with market volatility that's currently in the market. You might want to consider reducing that volatility and ensuring price stability through one of our fixed price energy plans or a renewable energy plan.
Excuse us, ladies and gentlemen. Bradford will be joining back in a moment. He's just having some phone technical difficulties. And so he'll be joining shortly, and then we'll go to our audience
All right.
Q&A.
Am I back on?
Yes, you are.
Perfect. Again, one of those things, one of those unexpected, unforeseen circumstances that can change things at a moment's notice. So glad we're back on. So as I was saying, 5 points that you should consider during this time. Number 2, has your energy reliability risk tolerance changed? Is emergency power more critical to your operations than before? Number 3, are you reducing staff or closing facilities? Or conversely, are you expanding your business? We want to know. Number 4, have you adopted new sustainability goals? Or are you finding it challenging to meet the sustainability goals you have in place with possibly less financial resources or staffing resources? And number 5, how important is capturing upside to you? Does your energy plan have enough flexibility to enable you to reap the financial benefits of demand response or demand management? Should the economy turn around, or when the economy turns around? Do you have that flexibility? If you're unsure about any of the answers to these questions, or have answered yes to any of these questions, we definitely want to talk with you and work our way through it. So one thing is certain in this time is change, and the opportunity presents itself to those who embrace it. We just want you to know that our team is here to help you navigate the road ahead through our comprehensive suite of solutions, which I have on the slide, whether it be with fixed price products, renewable products, flexible block and index structures. We also have energy efficiency services, sustainability consulting, demand response, distributed energy, a host of different products and services that you can move in and out according to your needs. The main thing to know about this is that any of these, in working with us, we can help you readjust your energy strategy if need be. So the financial and operational needs of your business have evolved over the past couple of months in order to keep pace with those of your customers. We want to know that as well, because it will impact you. So we're happy to partner with you to develop flexible solutions to maintain continuity and keep your business progressing ever forward. When we're discussing pertinent information, NRG recently released two articles that I think you'll find useful. They're at nrg.com under the Insights tab, and one's in Energy Education and one's in Innovation. The first one, how ERCOT renewable energy boom may reshape electricity pricing this summer. That's more of what Stephen and Bill just covered. So it talks about the renewables boom, demand peaks, and summer preparedness for businesses in ERCOT. The second article is how to think about your energy plan in uncertain times. That's more of the points I just covered. And what does all this mean? And then if you need to realign or readjust your energy strategy, this is a great way to kind of assess that, and if need be, reach out to us. So with that, I would thank all of you for being on the call today, and I realize everyone is busier than they've ever been. And so an hour of your time is much appreciated on our end. And we look forward to speaking with you, many of you, in the coming weeks. And on that note, I'll turn it over to John and see if there's any questions on the line, but feel free to contact us at any time, and I think our emails are being provided. So, John?
Thank you, Bradford. Bradford, Stephen, Bill, that was fantastic. I think you delivered on the promise to cover putting economic and energy news in perspective, kind of covering what this all means to energy pricing and supply choices. And then Bradford, I really like those 5 points to consider that you referenced at the end. At Smart Energy Decisions, we're conducting weekly advisory board meetings, and many of the things that you discussed in those 5 points are the types of things that are being discussed by our board members. That first point on budgeting in particular, I think budgeting in this environment has given people fits where load and usage is way down, but bills are not being reduced commensurately. And I know a lot of people are wrestling with the need to relook at how they budget for this year and beyond. So thank you for that particular perspective on what large power users should be thinking about. We've got time for a few questions here, and I'd like to jump right into it. This first one is, Bill, I'd like to direct this one to you. The question is, we've been hearing about the influence of net peak load on prices. If demand stays low, can this effect still occur?
Sure. And I probably should have thrown out disclaimer prior to my part at the beginning of this webinar, and it's that we do not certainly have all the answers, right? This is an event that none of us have ever seen before, and to try to know with any precision on how this is going to play out for the next year and a half, who knows how long. So we certainly don't have a crystal ball, but I do think we have seen enough data over the last couple months where we can start to form some insightful opinions. And so when it comes to peak net load, let me take a couple steps back. Net load is the market fundamental of how much load is actually served by conventional generation. So load subtracting out the output from renewables. Renewables, both wind and solar, are going to, assuming there aren't any transmission curtailments, are going to produce whatever they can produce at the highest amount they can, given the profile for the sun for the day and the wind patterns. What's left is the amount of demand, electricity demand, that needs to be served by dispatchable resources. And so as ERCOT has transitioned to more wind and more solar over the last few years, what we've seen as a much more impactful force to pricing is net load, not gross load anymore. So the total amount of load that's forecasted certainly has an impact, but not nearly the impact it did in the past. What is more impactful for pricing outcomes and scarcity is the load versus what the renewables are doing. And so peak net load is exactly what it sounds like. Is when we see peak load during the summer, like we saw last summer, that isn't necessarily going to be your high price day, the peak load day. The day where we have the net peak load, where the highest amount of load that remains after we incorporate wind and solar, that's the day that's going to be the tightest day. And that will certainly continue as long as we have a substantial amount of renewable output, which we will for the foreseeable future in Texas, even though we may have lower loads as a result of the impact of COVID-19 and stay-at-home orders. As I went through in my portion of the webinar, those loads are still forecasted to be record-setting. Even though we are suffering from the effects, the economy is suffering from the effects of COVID-19, we're still expected to see record electricity demand in Texas. And so that effect will absolutely still continue to occur. We're going to have to watch renewable output as well as temperatures when managing risk and understanding what pricing outcomes may look like for that period.
Excellent. Bill, you handled that one so well. I think I want to toss another one your way. If the load demand you describe continues into summer, how will this influence the 4CP programs in ERCOT? Does it still make sense for customers to sign up for these?
Absolutely. 4CP, as those on the listening in may or may not know, 4CP is the mechanism used to allocate transmission costs in ERCOT. And ERCOT uses the 4 coincident peak load intervals for the months of June, July, August, and September. Similar to the response to the prior question on peak load, absolutely, right? Those economic incentives to reduce consumption, to lower your transmission costs for the following year have never been stronger. We are seeing the highest total T-cost, transmission cost of service, cost allocation that we've seen. That continues to grow due to CREZ and other transmission improvements necessary for the Rio Grande Valley and for far west Texas. So those costs are continuing to go up, which means the incentives to respond to 4CP are just as strong and make just as much economic sense for customers to try to tap into. And so those services that are provided to help predict 4CP I would imagine are continue to be popular, and large customers that are exposed to 4CP rates will certainly continue to have those incentives to respond to avoid those transmission costs.
Okay, thank you, Bill. You knocked both of those out of the park. I'd like to ask this next question to Bradford. And Bradford, this is from the customer referring to their specific point of view. Because of the nature of what we do, businesses increase for us as a result of social distancing, and our energy demand is up. Is there still a good time to consider demand-side management or on-site energy? And if so, what approaches or measures might we be looking at?
Yeah. Wow, that is a great question. We hear a lot about businesses reducing their size or closing facilities because of COVID-19, but there are certainly businesses that are expanding as well. We've seen those in businesses that specialize in home delivery, manufacturers of healthcare technology, medical devices, data centers, anyone who provides cloud services or others along that vein. There are a range of options that were available pre-COVID, and they remain available now. So yes, it's a great time for you to look at demand-side management or on-site energy. From the demand side, engaging in demand response programs or demand management can result in cost savings or revenue generating opportunities. So if you've got excess load or you have the ability to shed load, you can turn that into real dollars and save your company money. So yes, it's a great opportunity. Along with that, there's customized low-cost renewable energy plans. So if you're looking at, you have excess load and you want to reduce and you have a contract coming up, there's new ways and new methods to tailor your next contract to meet your electricity demand needs, as well as going 100% renewable or some portion of. And lastly, for on-site energy, I think in distributed energy, there are a lot of businesses who are evaluating the reliability components or the continuity component of their electricity. And they're finding that their processes are more mission critical or essential than they may have previously thought. So if you're looking for that added peace of mind, distributed energy solutions or on-site generation are the perfect solution to provide that peace of mind, especially in an emergency situation. But I think that the key to all of this is really looking at all the factors of your business, not making quick decisions, but really thinking it through with a long-term energy partner who has the expertise and experience and the patience to want to engage with you and sit down and understand your business to craft a solution that meets your needs. I think in all of this, it's a true partnership, and it's not the different products and services that really push these partnerships forward, but they're a part of it. But the true centerpiece to all of this is trust and collaboration. And if you don't have those two, you don't have a partnership. And so I would suggest that you find a good long-term energy partner, build that trust and collaboration, and tailor their solutions to meet your business needs.
That was extremely well put, Bradford. I really like the way you answered a question that was focused on demand management, really at a higher level. I'm certainly hearing more and more customers interested in taking a step back and really understanding their total energy strategy, all of their programs bundled together. It's not just about supply, or it's not just about demand management, or it's not just about renewables. It's really about an integrated strategy that addresses all of those issues, and then being able to partner with a single entity that can provide all those solutions, I think, is just it's smart and it's efficient. So thank you for that. The next question that I have here is, Steve, I think you're up at the plate here, my man. The question is, our company has sustainability goals that we're seriously committed to. Is this still a good time in regard to price and tax credits to pursue solar?
Okay. It's a good question, John. Thank you. I feel like we're dodging bullets here. I was afraid you were going to ask me about something like ERCOT implied vol skew or something that, gets way over my head real quick. So I'm happy to tackle this sustainability question. And it's one we get quite a bit. As far as timing goes, I think there's obviously a lot in flux in Washington with regards to both production tax credits and investment tax credits with regards to wind and solar. Being on the origination desk here at NRG, we follow that stuff pretty closely, but I am in no way, shape, or form going to pretend to be a legislative expert today. So I do know that the clock is ticking, barring some extension. And there's been a lot of chatter in the newspapers lately about what may or may not happen with a stimulus bill and tax credits getting extended, et cetera, et cetera. I do know that the clock is ticking and that, there's some key dates out in 22 and 23 that projects have to be online to fully take advantage of those tax credits. What I do think of the part of the question of, is this a good time to pursue renewables and pursue sustainability goals? I think the answer to that is still absolutely yes. At NRG we have an innovative product we're calling Renewable Select. What it does is allows end-use customers to fully take advantage of all of the benefits of solar or wind offtake, renewable offtake with while shielding the end user from a lot of the traditional risks associated with those agreements. So it's a pretty innovative product that we're very proud of and have had quite a bit of success with in the market. And so NRG in the position we are, being a major player both on the generation side of the market in ERCOT and the load side of the market in ERCOT, we feel like we're uniquely positioned to be able to offer this product to our customers and help them achieve all of their sustainability and green goals, while at the same time, hopefully lowering their energy spend a little bit. And but like I said, giving them the full benefit of the attributes and the benefit of taking on a long-term renewable play intermingled with their load at the same time. So I know that's a little bit of a dodging the question on the first answer with regards to tax credits, but hopefully, if you're an end-use customer and an energy manager listening in, and sustainability and green goals are important to you and your firm, I think the Renewable Select product would be something that our team and Bradford would love to visit with you about.
Excellent. Thank you, Stephen, and congratulations on that Retail Select product. I know it's been very well received. Well, we're going to try to squeeze one more question in here under the wire. And Bill, I'd like to take this one back to you. The question is, has there been any notable level of generation / transmission line maintenance deferred during the spring due to COVID that might now cause issues during the summer with reliability? It's a great question.
That absolutely is a great question, and one that when we first saw the impacts of COVID-19 begin in mid-March, we had questions then about what the impact to grid reliability will be. I mean, that obviously is a huge consideration for those of us in the electricity business, for our regulators at the PUCT, in the legislature, in the governor's office, right? We want to make sure that that we can manage through this event from a grid reliability perspective. And that there's really good news to share in this aspect. Outage season has not been impacted hardly at all. A lot of the work that that needed to take place to prepare for summer reliability was already scheduled. Parts were already on site. Crews had completed a lot of the work. So there is not or was not a large impact to outages, and that was reflected as well in ERCOT's summer SARA. But now that we're really on the tail end of outage season, it does not look like that's going to be a problem at all for summer. So the outages were able to be completed this spring. We're not seeing a major disruption to supply as a result of COVID for summer operation, which is great news for the market, great news for the industry. Transmission, there are restrictions for summer outages for the transmission side of the house. Right, we want to make sure that we have the maximum amount of generation deliverability during the summer. So most of those transmission outages were already completed prior to middle of May. So no major issues there that have been reported that I'm aware of either. So just that, the good news from that aspect is we do not expect impacts to grid reliability due to loss of supply for the summer as a result of COVID-19.
Excellent. Bill, I know you could keep going on this, but we're going to have to wrap it up. I think we could all keep going because this is great, meaty material. Bill Barnes, Stephen Batchelder, Bradford Pete Hill, thank the three of you very much for doing a great job on today's webinar. I'd like to thank NRG for being just an outstanding partner of Smart Energy Decisions and making this webinar possible. Most of all, I'd like to say thanks to the members of Smart Energy Decisions Nation that turned out for today's webinar and are an active part of our community. Have a great day, everyone. Thank you very much, and we'll see you on our next webinar.